Okay, so New York's governor just made a policy move that's going to reshape the entire AI hardware race, and nobody's pricing it into the stock market yet. Here's the thing about regulation. It doesn't move stocks on the day the headline drops. It moves them 6 months later when investors realize what the policy actually does to the competitive landscape. Right now, that's happening in data centers. And if you own any AI stock, you need to understand the cascade. Last week, Kathy Hochul extended New York's ban on new data center construction. The official reason is water usage and power strain. The real effect is this. You just made it illegal to build the infrastructure that trains cutting-edge AI models in the Northeast. One of the 3 richest tech corridors in America is now off-limits for new compute capacity. David Sachs flagged this directly on the All In podcast. He said Hochul is being dishonest about the actual constraint. It's not water, it's politics. But the policy effect is real regardless of intent. Now, here's where this gets interesting for investors. The AI race isn't just about software anymore. It's about who can secure physical compute capacity in the places that matter. And Hochul just eliminated New York as a viable option for anyone except the companies that already have existing builds grandfathered in, or the companies wealthy enough to build elsewhere. Let me be specific about what that means. You've got 3 tiers of AI companies competing right now. Top tier, OpenAI, Google, Meta. They have billions in capital and can build data centers anywhere. They're fine. The Northeast ban is annoying but not fatal. Middle tier, Anthropic, Mistral, smaller labs with real funding but constrained capex. They wanted to compete by building modestly sized efficient compute clusters in dense population centers where talent and capital already cluster. Hochul just made that math impossible. Bottom tier, everyone else building on rented compute. They're buying from cloud providers. The policy doesn't directly hit them, but it raises the cost of rented capacity because now the supply side is constrained. But there's a 4th player, and this is where it gets weird. Elon's xAI doesn't build in New York. It doesn't need to. xAI is building in Texas, in Memphis, using excess power from Tesla's grid infrastructure and SpaceX's operational expertise. Hochul's ban doesn't constrain xAI, it constrains everyone competing with xAI. A new data center in the Northeast takes 18 to 24 months to plan and build. A new data center in rural Texas where power is cheap and zoning is clear takes 12 months. By banning the Northeast, you've just handed xAI a structural speed advantage. While Anthropic is fighting permit battles in Virginia or Massachusetts, xAI is already training models in Memphis. And here's the compounding part. This isn't a one-time policy. This is a template. If New York does it, California will follow. California is already tightening power grid policy. Once California bans new data centers, you've now constrained compute build-out in the 2 richest tech states in America. That forces everyone except the companies with existing capacity to build in the South or Midwest, which means paying higher energy costs or dealing with longer supply chains. xAI's cost structure just got better relative to everyone else, and it happened via regulation, not via innovation. Now, the stock market hasn't priced this in yet, because most investors don't follow data center zoning policy. They follow earnings calls and AI benchmark announcements. But the people who matter, the capital allocators at places like Andreessen Horowitz or Founders Fund, they're watching this closely. They're modeling out where compute capacity will actually be available in 2026 and 2027. And the answer is, not in the Northeast. Probably not in California either. That flows into xAI's valuation. It flows into whether Anthropic or Mistral can raise their next round at a sane price. It flows into whether a model trained on distributed, constrained compute can keep pace with a model trained on cheap, abundant power in Texas. The All In podcast's highest performing video this year was specifically about AI regulation and data centers, 366,000 views. That's 13 times the channel median. Audiences are hungry for this story because they sense the signal is real. Policy moves first, then capital flows, then stock prices follow. So here's the question. If you own NVDA because you think AI compute demand is endless, are you accounting for the fact that the regulatory environment is now actively constraining where that compute can be built? If you own TSLA or SPCX because of Elon's long-term upside, Do you see the advantage that regulation just handed him in the hardware layer? This is second-order thinking. The headlines say data center ban. The actual story is competitive landscape just shifted via policy. Most investors miss this because policy changes are boring. They don't feel like stock catalysts. But they are. They're just slow catalysts. By the time Wall Street prices it in, the people who thought about it 6 months earlier have already moved. If you want the full context on how these policy decisions ripple through AI company valuations, I went deep on xAI's hardware moat in a video I published last week. Link in the description. But for now, the key insight is simple. Regulation doesn't kill industries. It just picks winners and losers. And sometimes the winner is the company that doesn't need the regulated zone. And while we're on the topic of policies that make no sense, New Jersey just passed a law banning AI from making hiring decisions. Which sounds great until you realize every major company in the Northeast already uses AI to screen resumes. So what New Jersey actually did is make it illegal for New Jersey-based companies to be as efficient as their competitors in New York and California. It's regulatory self-sabotage, and apparently it's a trend. All right, that's it from me. If this was useful, hit subscribe. I do this every day. Have a good one.